So an estimated 15 million Americans turned to small dollar credit products in 2011. These individuals use payday loans, pawn loans, direct deposit advance, auto title loans, and non-bank installment loans in order to meet their needs for quick access to cash. Yet these types of credit often come with high fees. They sometimes come with challenging repayment terms, such as 2-week balloon payments, and that can make it very unlikely that the loan will be repaid without significant difficulty by the borrower. As a result, many borrowers roll over or extend their loans multiple times, finding themselves in a cycle of repeat usage and mounting debt. The lack of safe, affordable, high-quality, small-dollar credit options, as well as a variety of other solutions that could solve the problems for which people currently turn to small-dollar credit, is a major pain point for underserved consumers. Meeting this need with high-quality advice, products, and services is also a significant business opportunity. According to research by CFSI and Core Venture Capital, fees paid to access these small-dollar credit products in 2011 amounted to $17 billion. This is revenue that could be shifted toward products and services that meet the need for credit in a way that aligns provider and consumer success and builds economic opportunity for consumers. Developing those innovative new products and services in order to meet that goal will not be easy. It's clearly challenging, and we don't think it gets done tomorrow. But listening to the experiences of individual borrowers is absolutely the right place to start to figure out what those products and services should look like. And CFSI hopes to contribute to that goal through this new consumer research study that we've just concluded. And we're really pleased to be able to share those findings with you today. So without further ado, I'll turn over the microphone here to my colleague Rob Levy, who is a manager on the Insights and Analytics team and has spent a decent part of the last year getting to know the sort of smallest details about how consumers think about small dollar credit. And so he'll walk us through the research and take some questions afterwards. Rob.
Thank you, Rachel, and welcome everyone. Before we dive into the research, I figure it's always best to start with hearing the consumer's voice. So I wanted to read you just a few quotes. These are verbatim responses from the consumers that we surveyed. It was a multiple choice survey, but the very last question offered an open-ended box to say, tell us what you thought about your loan experience. And the answers were interesting and profound and varied, and so here are just a quick highlights of those responses. I have a hard time adjusting to the fact that everyday expenses, food, gas, utilities, meds, everything has gone up, and yet my salary stays the same, an hourly rate that has not changed in 2 years. Another consumer writes, due to the loan repayment terms, I was forced to continually take out another loan just to meet my basic needs. It was almost like modern day sharecropping in the form of a loan. I wish I'd never taken out the first loan. Another writes, my loan experience was a good one. The people were very nice to deal with and the process was quick and easy. These people gave me a chance when no one else would help me out, and I did not disappoint them. I paid every penny back on time as scheduled. Do not ever get a payday loan if you can help it. They are full of traps and crap. That line usually gets some humor where a chance where we can actually all hear each other. Unfortunately, that's not the case today. But I think that just gives you a taste of the consumers and how they're feeling about these products. But now let's see what the data tells us. So first, I just want to give a little bit of background about this study. The study was funded by the Ford Foundation. It's a two-part study, and what we're discussing today is actually part one, which is the quantitative survey. The goal of this survey was really to get a big picture understanding of small dollar credit consumers and how they're faring, and to be able to do some analysis of that data. And this was just published 2 weeks ago. The full report is available on our website at cfsinnovation.com. We are following this up with a qualitative study where we will be hearing from consumers of 3 different new innovative products, understanding why they got into the need for credit and used these products, and if these particular products are showing promise for them. And you should look for that report in Q1 of 2013. For both of these studies, the key research areas of focus can be thought of as being in one of 4 buckets. The first is demographics and financial state. Where are these consumers currently in their financial lives? The second is consumer need. Why do they need this credit in the first place? Third is the purchase decision process. How do they navigate the different options that are available to them? And then fourth is, what is their experience? How are they faring? And particularly in that section, we're really interested in understanding how consumers are ending up in the cycle of debt and the debt trap, which consumers they are, and how we can start to figure out how to improve upon that situation. So let's talk about the methodology for the study. This was an online survey. It was sampled from the nationally representative GfK Knowledge Panel, which is an online panel of about 50,000 people. And it's actually a really fantastic panel. And the way they keep this nationally representative is they use an address-based random sampling technique. They go out to people, invite them to join the panel. And if the individual does not have a computer or does not have internet access, this company actually provides that for them. And this enables it to be representative fully of the national spectrum, particularly around income and demographics that are obviously very important to a study of this nature. It was conducted in January of 2012. The population that we looked at was adults 18 and over with less than $75,000 in household income. This was to keep our focus on those who are the most financially challenged, although we do know, and we'll discuss later, that people with over that amount of income do use small dollar credit products. The main survey was from 1,100 consumers of small dollar credit, and to be a SDC consumer, according to our survey, you must have used a payday loan, a pawn loan, deposit advance, a non-bank installment loan, or an auto title loan at least once in the past 12 months. We also surveyed 500 borrowers of non-SDC products as a comparison group. These were consumers who said they had used a more traditional credit product like a credit card, a personal loan, or borrowing from their friends and families, but did not use a small dollar credit product in the past 12 months. And we just asked them a few questions, but we had some additional profile data on them that enabled us to make some comparisons, which we'll get into in just a moment. Because these products themselves come in many different forms and have by many different names depending on what state you're in or what company you're getting the product from, I want to go over some working definitions of the products to keep so that all of you can keep them in mind as we're discussing them. So the first product is the payday loan. This is probably the most studied of the products that we looked at. These are generally $300 to $500 loans where full repayment is due in 2 weeks after the date of the loan via a post-dated check or a direct withdrawal from an electronic account. Payday loans come with a flat borrowing fee, typically between $15 and $20 per $100 borrowed. A pawn loan is a loan of typically a few $100s secured by a physical object with a maturity of around 30 days and a borrowing fee of approximately 20% of the loan's value. A deposit advance, this is a loan or an advance offered as an add-on to a bank checking account where the funds are transferred to the account and repaid via an automatic deduction from the next direct deposit. Customers are typically charged $7.50 to $10 per $100 borrowed. For non-bank installment loans, these are loans ranging from several hundred to several thousand offered by non-bank providers and repaid in a series of installments given the name. There's usually a periodic interest, and APRs can range from 20 to 30% to up to 200%, as well as the terms can vary. And finally, an auto title loan. This is a loan also offered by a non-bank provider secured by a title to a used car, so similar in some ways to a pawn loan. These are much larger, typically near $1,000, but can range from a few hundred to $2,500. Borrowing fees are approximately 10 to 25% of the loan value per month. In our study, most of our consumers reported these loans being monthly installment loans of an average of about 12 to 13 months, although some of the more dangerous of these products on the market have 1-month terms, and it can be very similar to payday loans. Another thing that we're going to be using in this study is we're going to be breaking up these products into 2 different categories. The first 3 we'll refer to as very short-term credit. And that's because these products are really 30 days or less lump sum payment kinds of products. And then the last 2, non-bank installment and auto title, we will refer to as short-term credit because these are typically installment products with multiple month repayments. Again, auto title is a little bit questionable on that, but for the purposes of our research, that's how we categorized it. Okay. So now we'll look a little bit at demographics of these consumers. As Rachel mentioned, the first point is just to say that our incidence rate revealed 15 million consumers using SDC products in 2011, or over the past year, according to our survey, and that is across all income spectrums. The rest of the survey will now focus on just those with less than $75,000 in household income. There's a number of data points on this chart. Again, you can see the full representation in the report on our website. I'm just going to highlight a few that I think are particularly interesting. So first that we'll notice is that small dollar credit consumers, the leftmost column, are less educated than the non-SDC comparison group. So 59% of them report having only a high school diploma or less, whereas it's 45% for the comparison group. Obviously, having less education means it's harder to get a good job and harder to have steady salary. The regional representation is particularly notable. We see that SDC consumers are overrepresented in the South and underrepresented in the Northeast. I think this is largely a factor of supply, given that in the Northeast most of these products are banned or capped out of the market. But it's also an example of demand, where we know that there are more low-income and underbanked consumers in the South. We see that SDC consumers have larger households, an average of 3.2 members compared to 2.8. That means more mouths to feed and more financial pressures. And finally, we see, looking at the ethnic breakdown, that African Americans in particular are overrepresented amongst the SDC consumer group. Now, this is a finding that has been noted in many previous studies around payday consumers, particularly, as well as other small dollar credit products. It's complicated to get into exactly what the issues are here, and we're not going to focus too much on it, but the finding is particularly noticeable and was particularly strong. I want to talk a little specifically about the financial situations of these consumers. SDC consumers had an average household income of $32,000, and that's compared to $40,000 for non-SDC consumers. They took out an average of 6.45 total loans over the course of the year, and that's inclusive of extensions, compared to 3.7 for the comparison group. So we see that these consumers are essentially borrowing more often across the period of a year. They're also using a greater variety of loan products. So 2.1 is the average number of different types of loan products for FDC consumers, compared to 1.4 for the consumer group. And finally, particularly interesting with the question of access to credit and credit underwriting, we see that only 27% of SDC consumers say they had a credit card, whereas the non-SDC consumer group was at 61%, so nearly twice as likely to have a credit card. Looking more deeply at the distribution of income for the two groups, if you look at the blue bars, that's our SDC group. The yellow bars, the non-SDC. I think it's quite obvious, 43% of the group is below $25,000 in household income. What I think is a little bit surprising is to see that 20% of this group in the upper quadrant here of between $50,000 and $75,000 income, suggesting that there are many consumers that are making over the median income in the United States and yet still relying on small dollar credit products. I realize we're throwing a lot of data at you, so please send your questions in as they're coming, and we will answer them all once we're finished with the main presentation. So that was that first bucket, understanding the demographics and financial state of the consumers. Now we wanted to dig deeper into credit need. And there's a couple ways to look at it. The first is sort of the most tangibly, what did you use the money for? Where did the money that you borrowed go to? And here the answers are pretty standard for what we've seen in other small dollar credit studies. The top three reasons are very basic, everyday kind of expenses: paying my utility bills, my general living expenses like food or clothing, and to pay my rent. Where I think this is interesting is when we look at that breakdown now between very short-term and short-term credit that I discussed earlier. If we look at the yellow bars, we see that consumers are using very short-term credit more often for these really immediate needs, which are often quite frequent expected expenses, like a utility bill and your rent. Whereas the short-term credit products, those that are slightly longer in their payment structures and terms, are being more used for less frequent expenses, like a car-related purchase or repair, or a home repair. So we're starting to see consumers are using different products for different purposes. Of particular interest to CFSI was getting deeper than that, though. Not just what did you use the money for, but why were you short on the funds? Because it might be that you used the money to pay for that gas bill that came due, but it was 2 weeks ago that you lost your job or that your car broke down, and that's what ruined your financial planning for that month or put you off kilter. And so we tried to ask it this question, and we did our best. There's a lot more research I think that could be done on this. But why was there a fund shortage that month? And here we see a variety of answers that are particularly interesting, and I'm going to group them in a way that we found useful. The first is this lightning bolt group, which are the unexpected expense or the unexpected drop in income. And for these consumers, this is what we often hear industry talking about why they need these products. Is people just, something comes up unexpected, and these products can really come in at the last minute and be really helpful. And clearly for some consumers who do have a medical emergency or had their hours cut at their work, particularly in this economy, these products are proving or at least serving that need. But then it gets a little bit more confusing. We have this group at the top that said they had a bill or a payment due before their paycheck arrived. And we interpret this as there being some kind of cash flow problem, that money is due before the money is coming in, and there just isn't enough cushion for that consumer to make it through to be able to cover that payment, so they have to borrow a really expensive loan product in order to pay the bill. Here we particularly see the yellow bars sticking out of those very short-term products are being used for here a very short-term need, this kind of gap in the cash flow. And then the last group is sort of the most disturbing, and these are consumers that are really just in a bad situation. The group, my general living expenses are consistently more than my income. These are consumers who are using credit to fill a gap, and credit is never really going to be able to get you out of that gap if you consistently have this differential between your expenses and your income. And also for this group, the lower down, I spent most of my money that month paying off a previous loan. Again, if that's the situation, these consumers are really in a difficult situation, and we have to wonder if credit's actually going to be the right solution for these consumers. When we get later in the slides, we talk about the regression analysis, we'll see particularly that this point about general living expenses exceeding income is going to prove to be a key factor in which consumers end up getting into the cycle of debt. In addition to taking credit, we know that consumers actually do other things in order to manage whatever it is they need the money for. And we just wanted to ask you sort of what are the variety of things they do, and I think this is interesting to note. A lot of people will say, well, you shouldn't take out a loan, you should just reduce your spending, or you should just go without a little bit. And what we found is that consumers are already doing this in addition to taking out these funds. They're reducing their general spending, they're going without certain basic needs, they're deferring or they're skipping the paying of bills, or they're working more or trying to earn more income. And this is fairly uniform actually across the two different types of products. Another particular question of interest to CFSI has always been the relationship between savings and credit. And we really wanted to understand, did you have savings? Were you using the savings in addition to the loan? What's the relationship there? And so we found that 2/3 of the consumers reported, not surprisingly, that they had no savings. These are consumers in difficult financial situation with low income, as we've already seen earlier in the data. But of the 1/3 who said they did have some savings, what was surprising was to find that more than half of them said they had savings, but they chose not to use all of it. And instead, they relied on what is pretty expensive credit. And I think that's a really interesting finding to say that there is a reason that credit and savings can exist side by side and might both play a role in consumers' lives. And it's not just you sort of drain down all your savings before you go to credit. But there's a role for both. Now, why consumers didn't use all of their savings, though, is of course a question, and we weren't able to get that much deeper on it in this kind of survey. We're going to try to in our future research. For some, it might be there's a structural issue that the money is tied up in a 401k or a CD. I think for others, though, it might be a behavioral question, that money is sort of allocated towards a certain purpose. It might be a college education for the kids. It might be towards that real emergency when I can't get a loan. Who knows what it is. But people really value their savings, and they're choosing not to use it. And I think that's a pretty important finding here. As consumers now go about deciding, okay, what loan am I going to use, we wanted to understand what attributes were the most important to them. And we asked a series of questions, and here were the loan attributes that we offered to consumers. They were randomized for each panelist or other participant in the survey. And what's interesting, the ones that popped to the top. The top 3 attributes that were most important to SDC consumers were the speed that they were able to get the money, that they could simply qualify for this loan, and they knew exactly what they would pay if there were clear terms. And these were true across both product categories. And I think this is something really interesting to keep in mind as we're trying to come up with innovative alternatives and small dollar credit options, that speed and convenience and just acceptance are really top of mind for these consumers. One thing that did stick out for the short-term credit consumer group was the ability to pay back over multiple payments. So the short-term credit are those products which are installment products. So it says for consumers of those products, that feature was highly valued by them. Finally, we found that over 2/3 of SDC consumers do not comparison shop within a product category. So if they're going for a payday loan, they don't actually go and check 3 different stores for the cheapest price. And this is sort of anecdotally known, but was interesting to find out quantitatively. And it suggests a number of things which are hard exactly to know, but I think that one is these products are fairly uniform in the marketplace. So it might be that consumers simply know there isn't much point in comparison shopping. And it might also be that, as we see here, the real priority is on speed. That there's a real urgency of the need for cash, and that they go to the first place that'll give them the loan. So why not use other credit options? Why not use a credit card or overdraft? We asked consumers this question as well and got some interesting answers. For a credit card, the number one reason consumers didn't use it was because they don't qualify, which is aligned with the numbers I showed you earlier in the presentation, that many of them consumers said they don't even have a card. Then there's also a group, 19%, that said, I did have a card, but I've maxed it out and I can't use this product anymore. And some people even find a credit card too expensive, especially if you get into a high amount of debt. For overdraft, there's a different set of reasons. The number one reason not to use overdraft is because it was too expensive. And we certainly know that when one overdraft is sort of $36 on average for one individual expense, that extra latte, that can be a particularly expensive form of credit. Or it's too inconvenient. It might be that there's no bank branch near me, or I don't have a bank account. And finally, with loans from friends and family, now this is typically the number one place where consumers go when they need a loan. And in fact, we find that 21% of them said, I did go here in addition to using a small dollar credit product. But for those who didn't, they said it was too inconvenient, which I would interpret as I don't necessarily want to ask Uncle Joe for this money, or it's not offered near me, which might be that my cousin or my parents or my cousins don't have this kind of money available. Okay, we've gone through the sort of process now. We're going to look at the experience. What happens to these consumers when they use these loans? First, we're going to look at a single loan experience or episode. And we define this in our survey as sort of from the acquisition of the loan until the final moment of either repayment or default, inclusive of all the rollovers and extensions that happened within it. But this is not looking across the entire year. We'll get there in the next slide. For payday loans, the question was, did you pay off your first loan on time? So at the end of that 2-week period. And here we see that only 62% said they did, and 38% say they did not. Of that group that did not pay off that first loan on time, a small percentage end up defaulting, and the bulk of them are rolling it over. Of those that roll over the loan, which again means to sort of renew or take out a new loan immediately the day after paying the loan off, we found an average number of rollovers was 5.1 for these consumers. For pawn, asking the same question, we see even less, only 55% said they paid the first loan off on time. Of the no group, again, a small percent end up defaulting and lose their object. And of those that extend the loan, they extend it on average of 2.4 times. Finally, for a deposit advance, this was a little trickier because the nature of deposit advance is that there's an automatic repayment mechanism, so you can't really roll over or extend the loan, so to speak. We tried to get at this question of repeat usage by asking, did you pay the first loan off without overdrawing your checking account? The way deposit advance would work is if for some reason you didn't have a direct deposit go into your account, Typically after 35 days, the amount would then be withdrawn directly from your account, and if you had insufficient funds, it would result in an overdraft. Here we see only 15% of consumers saying that they ended up in this situation of overdrafting their checking account. That can be a little misleading though, because as I said, most of these consumers are set up on an automatic repayment system, so it's just automatically taken out without their choosing. To understand this question of repeat usage, we said, well, did you take out another advance in the next month? Which is a situation many consumer advocates have recognized is similar in some cases to a rollover. And here we saw actually the highest number amongst all the products, 35% of consumers saying they did take out another advance in the next month. So this suggests that even if they were able to pay off the advance with that deposit, that it left them short and they immediately had to take out another, and that's certainly very concerning. Now looking across the entire year, we extrapolated from some of our data to say, well, how many loans are these consumers using across the entire year and how many days are they in debt? We were only able to do this for payday and pawn because of the nature of our study, but the numbers are really alarming. For payday consumers, we found the average number of loans and rollovers or extensions, if we think of them as each individual loans, was 11 loans per year. And that means that an average number of days spent in debt is 150 days per year. And this is fairly consistent with other research that's been out there from the Center for Responsible Lending, as well as a recent study from the Pew Center. With pawn, we found similar numbers. The average number of loans or extensions was 7. Because these loans are typically of a longer period, more like 30 days, this means consumers are in debt on average 200 days per year. Now let's look at the short-term credit products and see how consumers fare. These are a little bit different, of course, because they're installments. So it's not all one lump sum payment. There are multiple options to pay back. There are also multiple opportunities to default or miss a payment. We asked the question, did you pay off the loan by the end of the original term? Here we see just over 3/4 said yes, I did. 24% said no, I did not. Again, a small percentage of the no group ends up defaulting. Most of them end up refinancing, an average of about 3 times. With auto title loans, the same question, we see less, only 71% say they're paying off by the end of the original terms, with about the same number of refinances. Looking at these numbers and seeing particularly the numbers of repeat users in the very short-term credit products, we really wanted to understand, is there anything from our data that can predict repeat use? Which of these consumers are going to end up in that situation, and which are going to be able to make it out okay and handle that credit crisis with the product? And we found some interesting results. We really tried to analyze almost every variable we had in the study, and we had a lot of numbers. And I should thank my colleague Warwick O'Brien, who's a researcher at Princeton, for doing a lot of this analysis. The first thing that we found was that when we looked at the ratio of loan size to income, we saw a strong correlation to the number of payday rollovers. And this basically just says that when a product is not underwritten for the ability to repay, when the amount that a person owes is a great proportion of their income, they're more likely to roll over and repeat use. Maybe this is obvious, but this was, strikingly struck out amongst our data. Now, if you remember the slide earlier that I was discussing about credit need and the reason for fund shortage, one of those reasons that people said they had to use credit was because their expenses were consistently higher than their income. And we tested now all the answers that people gave, whether it was the cash flow issues or the unexpected expense. Only one of these popped out with a connection to repeat usage, and that was those consumers who said, my expenses are consistently higher than my income. And with those consumers, we found a higher likelihood of repeat usage amongst 4 of the 5 products that we looked at. So they're more likely to roll over a payday loan, to extend a pawn loan, to refinance an auto title loan, and to use a deposit advance again the following month. So this really suggests that if we can understand consumer situations and in the process of underwriting, pick out those consumers that are in this really financially challenged situation, and it's possible that credit might not be the right solution because looking at them, they're going to end up in this repeat usage situation where really it's not clear that the credit product is actually making their lives any better. And similarly, it could allow us to identify those consumers for whom credit could serve an important need. Finally, we asked a series of consumer experience questions and satisfaction questions. And I think this is important because even though we saw these high rates of repeat usage, we know anecdotally that consumers use these products and like these products. And maybe they know they have no better solutions, but that is sort of what our data shows here. And so we asked a very general question, how satisfied were you with this loan? From 1 to 5, 5 being the best. And here, if you just look at the 5 and 4s, the black and the blue bars here, you see that more than 50%, for almost all 5 products of the consumers, say they were satisfied or very satisfied with their experience. Again, it does not suggest these are quality products, but it does suggest that consumers are satisfied with what they got. Of course, if we look at the bottom 2 bars, the 1s and the 2s, we see there is this significant minority of consumers who are really having very negative experiences, particularly high with payday and auto title loan. Of course, we wanted to get a little deeper and not just say how satisfied were you, but what did you think of the product in terms of fairness and how did it act with regard to your original expectations of the product. And again, you can look at sort of these numbers in more detail in our full report. What I want to pick out is how the products compared to themselves. And I should say, I wish I had numbers here to compare this to credit card or overdraft, but unfortunately our survey did not ask that question. But comparing amongst the 5 SDC products, we see, again, payday loans and auto title loans really across the board having the lowest numbers. So the lowest numbers in terms of consumer rated fairness, the highest numbers for consumers saying this cost more than I expected it, 40 and 43% saying this was more expensive than I expected at the beginning. I think it says a lot about disclosure and where things need to go with pricing. You also see, 30%, more than 30% of consumers saying it took more time than I expected to repay the loan. So maybe they thought, I'd get this loan done and at the end of that first payment, that first term, and I'll be okay. But a lot of them end up being surprised by how long it takes to pay it off in the rollover or refinance situation. And would you use the product again? Here we see, 22% saying outright no, and only 30 or 20% saying yes, I would without hesitation. It's also worth noting that amongst the 5 products, deposit advance does come out better. Now, of course, the comparison group is what it is, but they have the highest ratings for consumer fairness, the lowest number of consumers saying it cost more than I expected or that it took more time than I expected, and the only product amongst the 5 where a majority of consumers said yes, without hesitation, I would use this product again. Conclusions. And then we'll be happy to start taking your questions. It seems like a lot of them have come in, which is really fantastic. First, just seeing the variety of products and needs and situations that consumers are in, we recognize that many consumers would really benefit from a multiplicity of safe, affordable, high-quality credit products and tools that are designed to meet different needs and different uses. There might be a role for lump sum and installment payment products, a role for short-term and medium-term, or very short and short-term, a role for secured and unsecured, and that different needs can take different products. But for some consumers, I think our research makes very clear that the best long-term solution may not involve credit at all. And now as we're thinking about new solutions, if we're going to try to meet these consumer needs safely, that high-quality credit is going to have to balance affordability and sound underwriting with speed, convenience, and accessibility that consumers crave and that they're already getting from existing products in the market. Our research around saving suggests that high-quality credit can play a role in consumers' lives alongside and possibly linked to savings. The regression analysis suggests that underwriting that can get deeper into a consumer's ability to repay and their overall financial situation will be really critical to preventing the problem of repeat usage in the cycle of debt. And finally, that we're going to need strong consumer protections and innovative new high-quality credit products if we're going to try to address the struggles and needs of SDC consumers in a comprehensive way. So those are our conclusions. I'm interested to hear your thoughts, and I'm going to ask Rachel if she has a first question for us.
Sure. So we're actually going to back up a little bit, of course, and start first with the questions that we got about methodology, and then we'll sort of go chronologically through the questions that we got. So we'll end up back here at our concluding thoughts again. So some of the questions we got were about the income range we used, and the And sort of why cut it off to 75,000, I think is worth reiterating. And also, it's clarifying where the calculation of the incidence rate connects to the cutoff, right? So is the incidence rate that we're talking about only for households who are below 75,000, or is it a total usage of small dollar credit?
Right. So the reason that we capped it at 75,000 were two. So the first was that we really wanted to be able to focus on those consumers that are generally, LMI consumers, low to moderate income. And it's sort of a sample size question. If we expanded it significantly beyond that income, it might have been hard to get the number of consumers we wanted in the 5 products so that we could say something quantitatively as significantly valuable amongst those smaller subgroups of our study. So it was sort of a methodological decision, as well as essentially a cost decision that it was sort of made more effective use of our dollars to focus on that group. If we had unlimited funds, I would have absolutely surveyed the full range of the income spectrum, but we're a nonprofit. And then in terms of the incidence rate, so it's a little confusing. The exact numbers, I think, worked out to, I want to say about 9 or 10% of consumers had used, under 75K, had used one of those products. And so essentially, if you then applied that to the number of people with under 75K in household income, what you get is about 13 million consumers that, sort of statistically based on our representative sample, had used an SDC product under the 75K cap. We wanted to get a number that would explain the full range of consumers, because we know that there were consumers above 75K using these products. And so we did a little back of the envelope math using FDIC analysis, the FDIC underbanked survey from 2009, which actually had numbers on how many people above 75K were using alternative financial services credit products. We did some back of the envelope math, and that's where we went from 13 to 15 million. I think that's a pretty safe bet. We do in the paper refer to it as an estimate. It's not a sort of hard number, but I think it's pretty close to what's right.
Terrific. And we got several questions around the why questions that we asked. So in particular, when we were asking what was the cause of the funds shortage that led somebody then to later choose to use small dollar credit, could people answer more than one question?
Yes, they could. Yeah, because we certainly know consumers often have multiple needs that lead them into a credit situation.
Another methodological question was around how we thought about the number of times that credit was used. So we were doing comparisons, of course, of the number of times different products were used, including credit cards. Mm-hmm. So how do we think about how you can estimate the number of times a credit card is used?
Great. And that was a hard question for us to figure out. The way that we phrased it in the survey was when we asked about products like a credit card, which can both be a sort of a payments product and a loan product, we try to be as specific as possible to say, when did you use this credit card to make a purchase with the intent of not paying off the bill at the end of the month? So with the intent of using it as a loan product. I agree, it's not perfectly clear that consumers would have fully understood that. So we should take the answer with a grain of salt, but the numbers did show us that SDC consumers were using sort of more individual loans over the course of the year. It might also be that many of them, as we saw, don't have access to a credit line, which they might think of as sort of one loan over the course of a year, and are using more short-term products that actually have sort of end dates and are not lines.
Makes sense. And sort of a follow-up question was we were asked how we would think about credit card products when you're thinking about the number of days that somebody's in debt, right? So why is it a valid benchmark to think about the number of days that somebody's in debt for Payday and the other products that we looked at here, when you don't think of credit card customers necessarily as in debt 365 days? Right?
I mean, I think a lot of research does actually look at how many days consumers spend in debt, or sort of how many months they actually have a remaining balance on their card and don't pay it off. I know Demos has done some really great research on that area, particularly with LMI consumers, and I would highly recommend taking a look at their research. We didn't get as deep into credit card uses on this study, But I certainly think, consumers, and we saw this with the credit crisis, was a big cause of it. Consumers racking up huge amounts of debt on their credit cards and not paying it off for months on end. Certainly, I should say one of the biggest differences that even in the worst credit cards, the most, subprime credit cards, the APR gets up into the high 20s, whereas with a payday loan, the effective APR can be close to 400%.
Terrific. And similarly, we got some questions on the other end of the spectrum, people asking why not include overdraft. So say more about why overdraft isn't in our list of products, since for some borrowers, or for some users of overdraft, I should say, that the repeat usage makes it look like people are using overdraft as credit.
Yeah. No, you guys are asking such great questions. We thought about this really hard. I think we decided intentionally not to use overdraft because the way that overdraft is structured is so different than the other products that we looked at that we were afraid it would be hard to ask the right questions and be able to get data that would be aligned with the rest of the products we were looking at. And so many consumers sort of mistakenly use overdraft and without intentionally using it as a loan, and they can get multiple overdrafts for small products. It just seemed a little bit too confusing. I think also with the regulatory changes in the last few years around overdraft, that we weren't sure that we could accurately align what we found from the consumer with what we know is going on in industry. And so we decided for the purposes of this study not to look at it.
We also had more than one question of people asking about regional variation. So, what can you say, or sort of, what can we know from our study about how usage of these products, all of them, varied by usage? So more payday in one place, more installment loans somewhere else.
Yeah, so that's high on our list of the follow-up data analysis reports we're going to do after we've got this initial report out, is to do some regional breakdowns of our data. I should say that everything I showed you today was really a nationally representative and nationally oriented research. Certainly with regards to some of these products, there's huge amounts of regional variation, whether it's the availability of deposit advance or the regulations around payday loans or auto title loans. We did see, obviously, in the South a lot more consumers, a lot more SDC consumers showed up in our survey, and the South is generally overrepresented in the study because that's where the consumers are that are using these products. What we hope to do in the months ahead is to do some analysis between looking at those states that have, say, really restrictive regulations around credit to somewhere in the middle, and then really open and lax regulations around credit, and then be able to cross that against our data and see what it says. I don't know that we'd see that much surprising, though. I think what you would see is the states where it's unregulated, you'd see a lot more consumers using it, a lot more consumers getting into trouble.
Similarly, we got some questions about how much we can compare the different products. So, for example, what do we know about the repeat usage of deposit advance versus the repeat usage of paydays, or anything that we can say about how the different size of those types of loans, or the different typical sizes of loans, may then interact with the level of repeat usage? Is that a question for our next layer of analysis?
That question is harder because that's really hard to do with consumer-based data. Right? We ask the consumers to tell us, how much did you borrow, and when did you borrow, and how long did you have it paid off. I think to really get at the nuances of that, you'd want some transactional data, that you would get from providers or from state databases or whatever it might be. Deposit advance, for example, is particularly tricky. You can take deposit advance out in $10 increments. So, a consumer might take out $20 here, 3 days later take out $40, 4 days later take out $10. Now, is that 3 loans or is that 1 loan? It all comes out of the next direct deposit, but it can be difficult to get from the consumer kind of how many loans, quote unquote, they actually took out. So I think transactional, provider-driven analysis will be really key to that. We would love to do some. I know the CFPB is looking at doing some of that kind of analysis, but it's hard to get at exactly from just consumer-driven research.
Yeah. Similarly, we got another question I think interesting to think about, but I'm not sure our research answers, which is about, as we think about the satisfaction rate with these products. And one of the questions that we looked at, right, was whether or not the loan cost what people expected it to cost. So, the question that we were I have to actually, this is one where I can't paraphrase effectively. It's better to just read it. And somebody said, well, what is the factual basis of our conclusion or our inference that borrowers' underestimation of the cost of the loan may be the result of a disclosure failure versus the potential for an optimism bias on the part of the borrower?
I should say certainly I think both are in order, absolutely. I think we actually did ask a question around confidence in the study, which, amongst a number of questions we weren't able to publish in this report and are looking to put out in future reports, and we did see certainly a higher level of confidence than the number of people who end up rolling over or defaulting on their loans. So I think that's absolutely right. Although I do think disclosure is an issue because, particularly with the payday products, I think, they do have big signs, right? In the stores that say you're going to pay 15 per 100, and if you borrow 300, you're going to pay 45. And that might seem like really good price disclosure, but if they're not disclosing or being really clear about the likelihood of paying off, like if they said to you, hey, just so you know, 40% of people aren't going to pay this off in 2 weeks, or 4 of the 10 of you in this line are not going to pay this off, then you might start asking yourself, well, is that 45 really going to become $90 or $135? And that's where I think that proper disclosure, it's a big question for all of industry. How do you disclose what's the real likelihood of payment and of repayment? And that's what I was trying to get there with that inference.
Yeah, I think that's an important direction for this conversation to go, as much as a webinar with our structured Q&A can be a conversation. So some of our listeners ask questions about what's safe and affordable and what you do if our research says that not everybody's needs are going to be satisfied by credit. Some people need to be looking at other options. How do you set up the boundaries? How do you set up the system so that people do make the choice that you've just described in a useful way?
And if I knew the answer to that question, we'd be done here.
Right.
No, I think that's exactly the question that CFSI is trying to figure out. And I think there's clearly a lot more research that needs to be done to get at that. And it's hard to say. For those consumers for whom they really are just so likely to end up in the debt trap, the situation might not be credit. The solution might not be credit. The solution might be that we need income supports or nonprofits and volunteers and all kinds of other efforts to support these consumers. Like the many Americans that are just in a really difficult situation right now, and the two candidates for president are discussing all kinds of ways to address this question. It's beyond the purview of CFSI, but one that we as a country need to address. But I think credit isn't necessarily going to, a loan is necessarily going to help them, and in fact, it may make it worse. When we start then talking about, well, what's a high-quality loan, what's a safe, affordable, high-quality loan, CFSI is in the process and will be more deeply over the next year and a half through our Compass Principles initiative of trying to define just that question. What are the components of a high-quality loan? I think underwriting will very clearly be one of those elements, and that a product should be underwritten with some sense for the consumer's ability to repay, and that might mean saying no to more consumers. And in some cases, that might be the right solution. In other cases, it might be a tiered product where you start off with a very small line of credit, and then by demonstrating your ability to pay that without a high risk of getting into repeat usage, then you can get a slightly bigger line of credit and a slightly bigger line of credit as you improve your or prove your credit worthiness. There's a lot of ways I think this can be done, and most importantly, I think there aren't enough products yet on the marketplace attempting to find solutions to this question, trying different kinds of underwriting skills, underwriting techniques, different kinds of loan structures. We see a handful of them in the marketplace. CFSI is an organization that is all about innovation in credit, and particularly when that innovation is good for the consumer. We'd love to see a lot more of that. We'd love to see more options and more testing and more opportunities for providers to try things out and startups to try new things that we've never even thought of and start to see what works.
Thanks. I think that answers a number of questions we got around what sort of criterion would we start to think about, or what additional features would we want to see in small dollar credit to make it higher quality. Some specific questions that build on that were around the usage of savings as well as small dollar credit. So I know you said a little bit about that in the PowerPoint that you just shared, but what more would we want to see or want to know, or what other speculations would we make about why people are partly using savings but not entirely, or how savings and credit could interact?
Yeah, I think I would look at that in two ways. Excuse me, a little frog in my throat. The first is, I think, that our data just suggests an overall sort of idea that savings can have a role even while credit is useful for a consumer. And what I mean by that is that if we were to say that the solution to the problem with credit is just give everyone a savings account and help them build up, $2,000, $3,000, 6 months worth of expenses in their savings account, then they won't use credit. I'm not actually sure that that's accurate. I would absolutely love to see that day exist when that is such the case, but I think there will still be times when consumers need credit. It might be because they want to build their credit score. It might be because they have a particular purpose identified for that savings and they want to keep that for it. It might be that they like the repayment mechanism of credit that's going to force them to repay it back on a monthly basis, so that they know they'll replenish that and their savings will stay intact. And then the second, I think, implication of the finding around savings is that the savings and credit can actually be linked at times into one product where both savings and credit exist. So we've seen in the developing world a lot of the microfinance loans incorporate a savings component, a compulsory savings component, as part of the product. And here in the U.S., we're seeing a number of products start to do that. One example is the North Carolina State Employees Credit Union, which has a deposit advance-like product where 5% of the loan goes directly into a savings account. So that the way that works out is after about a year and a half, you essentially have the amount in savings that you would otherwise take out in a loan, and now you can either just use the savings instead of the loan, or if you want to keep the savings intact, you're offered a secured loan at a lower interest rate that's secured by your savings account. There's another product out there called Tandem Money, which is sort of like a prepaid card with a savings component. This is a new product, and we're still waiting to see what the results are, but they enable you to take out a little bit of credit and then replenish that credit and then build up some savings. And then the next time you need a loan product or you need $200, you can take $100 from your savings at no interest rate and $100 from credit at some interest rate, and then repay them both so that you're replenishing your savings while paying back the credit. I think there's a lot more ways that savings and credits could be tied together, and I think we would love to see more innovative solutions that bring these two closer.
Terrific. So we're getting near the end of our time. I want to point out that we've received and continue to receive more and more questions, which is fantastic. And so I want to encourage you to reach out to us outside of the webinar format, and we're happy to keep talking about all the issues that you're pushing on and the questions that you're asking about our data. That's fantastic, and we want to keep talking about it. We have not gotten to all of your questions by any means. I also want to point out that some of you have used the question feature here to offer to help do additional research, and we're thrilled about that, and I have a huge smile on my face. And if one of the people who made that offer, please do follow up with us outside of the webinar format as well, because we think that there's a lot more questions here to continue trying to understand. So thank you very much for that engagement and that interest. Rob, I'll leave you with the last question. At least several people said, when will we see more on the qualitative, and what else can you say about it? And where can we find this deck and the associated research?
You're right. I'll answer them in reverse order. This deck will be available the deck itself will not be directly available, but there will be a video. This whole presentation has been recorded and will be available online on our website. I think it will get sent out to everyone who registered for the webinar, and should be available through our website, usually within a day or two. We're pretty quick at that. Please share it. I highly encourage you to share it with your organizations and companies and agencies. The full report is on our website. It should be pretty easily available off the home page. There's a little rotating graphic that says CFSI's latest small dollar credit research. And then I'll also, for those of you who are interested, I'll also be presenting this research at the CFED conference in DC, as well as the SDC Consumer Research Symposium, both later this month. The qualitative research, we can't yet say which companies we are partnering with, They are 3 different companies with newer products on the marketplace. For each of the companies, we've got about 10 to 12 consumers that we've done one-on-one, 1 to 2 hour interviews with, which are just fascinating. We even were able to get some audio recordings of some of their stories, and we're going to hopefully be able to put them online. The research is being conducted by Jenny Romick, a professor at the University of Washington, who is an expert in low-income financial services. And that report is expected to be published in Q1, hopefully January or February of 2013. And then we'll be presenting on that most certainly at our annual Underbanked Financial Services Forum, June 5th to 7th in Miami, Florida. And I hope you guys will all come and join us.
Terrific. So thank you again for joining us. We're really happy to have you here and look forward to continued conversation with all of you about small dollar credit. Have a great rest of the day.
Thanks so much.